Good evening, everyone, and welcome to UTI Mutual Fund's Fixed Income Market Insight webinar. The past few weeks have seen several important developments shaping the outlook for fixed income markets. While geopolitical developments continue to evolve, global inflation dynamic in recent weeks have benefited from the relatively softer commodity prices, even as manufacturing activity has shown sign of gradual improvement across several major economies. At the same time, domestic markets continue to balance supportive macroeconomic fundamentals with evolving factors such as progress of monsoon, external sector dynamics, and liquidity conditions. Against this backdrop, investors are increasingly focused on understanding how these evolving global and domestic developments could shape the outlook for the interest rates, bond yields. In today's session, we will begin by discussing the key global macroeconomic developments and their implications on the financial markets. We will then shift our focus to the domestic landscape, where we will discuss about evolving macroeconomic environment, inflation, liquidity trends, fiscal developments, and the outlook for fixed income. I'm Sandeep Solanki, product specialist, and I'm joined by Mr. Anurag Mittal, who is the head of our fixed income, who will share his perspective on these developments and discuss what they could mean for the fixed income investors. With that, let me hand it over to Anurag. Anurag, over to you.
Hi, good day everyone, and welcome to UTI Market Insight Fixed Income for the month of June 26. While the last 3 months have been nothing short of eventful for global as well as domestic macroeconomy, the month of June, especially gone by, I would say was in a way quite historic, apart from being eventful as well. So on the global side, of course, there was a ceasefire between US and Iran, which led to cool down in oil prices. Of course, as we speak, there are reports of that ceasefire being violated, and both the parties are working on that. But yes, in a way, that led to a severe fall in oil prices for the month of June and resumption of supply lines for oil and oil derivatives. And domestically, we apart from the FCNR guidelines being relaxed, which we talked about last time, we of course had the removal of withholding tax as well as capital gain tax for foreign investors on Indian bonds, which is probably paving the way for Indian bonds into Bloomberg index inclusion. So we'll discuss all of that and other things and the right strategies for the current environment. But starting with the global macro trends, as we can see, global manufacturing continues to do quite well. In fact, the number of 52.2 is the highest since 2022, so highest since 4 years. And although on the face of it, it looks quite strong, but it signals an uneven economy. So you had US, China, South Korea, and Japan, which are running red hot manufacturing thanks to spending on data centers, thanks to spending on AI, thanks to spending on power generation. And then you have Europe and some parts of Africa, which were experiencing sluggish growth because they were hit by higher energy prices and supply chain disruption. So that's uneven recovery, but broadly at an aggregate level, manufacturing globally continues to do quite well. So it's in a way a reversal of the book, which or the global growth book, which was running post-COVID, because what we saw post-COVID normalization from 2022 to 24 was, and if you can see, services did really well. So as you can see from this chart, the orange line, services PMI was doing phenomenally well across 2022. In fact, all the way till 25, and manufacturing was slightly muted as there was revenge spending, whether on travel, on construction, real estate, etc. Things were doing well. But as that benefit is now passing on to the manufacturing, so now we are seeing manufacturing overtaking services. Now, if you look at in fact services, especially thanks to AI, we are also seeing significant job loss. So if you look at the breakup of services PMI, that's showing meaningful job growth decline, especially across developed markets. So while of course it's a first signs, we don't know whether it's a trend or whether this will continue or is a short-term blip. But that's a very interesting reversal that we have seen where globally manufacturing is becoming the key driver of growth rather than services. And when so and the good thing about the US economy is it's very service oriented economy. So just like India, almost 60% of US economy, in fact more than 60% comes from services. So when services were doing well, the US economy was running red hot, doing quite well. And when manufacturing is doing well, the US economy again is at the forefront. So whether you look at spending on semiconductors, spending on AI, US is again leading the innovation. So that's quite, in a way, innovative by the US, whether it's services or manufacturing. Somehow they always manage to catch the right trend. They manage to course correct and be ahead. So that's a very interesting development we are seeing. And even if you look at on the right hand side chart, which is the HSBC US Economic Activity Surprise Index and the EU Economic Activity Surprise Index, which basically measures the actual data release compared to the expectation, the US economic data is surprising positively consistently. So if you look at 2020, end of 25, or even all the way in 26, US economic data has been doing quite well. And if you look at Europe, Europe economic data is continuing to underwhelm expectation. That's the unevenness that we were talking about, that largely the growth is led by US and some parts of Asia, which are at the forefront of manufacturing, or they're contributing towards spending towards AI, whether it's South Korea, Taiwan, Japan, and of course China. Coming to the how commodity prices did during the month of June, while for the months leading before June, whether it was March, April, May, we were facing major disruptions in supply chains. We were facing the Strait of Hormuz closure, and in a way, about mid of June was an inflection point where after the ceasefire between the US and Iran, the Strait of Hormuz opened, and we saw a sharp fall in oil prices, not only oil prices, but oil derivatives as well. So, for example, fertilizer prices fell by 50% because, like we discussed in one of the previous webinars, the Strait of Hormuz not only contributed towards 20% of global oil supply, it also contributed in a big way towards agrochemicals. It also contributed in a big way as a major transit point for fertilizer as well. So as the Strait of Hormuz opened, it led to the floodgates in a way, literally, where most of the shipping lines which were stuck, they were able to pass through the Hormuz, and suddenly we saw a huge cash supply across. So while we don't know whether this oil price of 70 to 75, which is where it's hovering at right now, whether that will sustain or not, because we need to see whether the ceasefire holds more permanently. But broadly, at least we are much way below the peak of 110, 115 that we were seeing in the month of May. And that's also having an effect on food prices, because as oil prices fall, as fertilizer prices fall, we are also seeing some benefit now being there in the food prices as well. But of course, in India, we are still awaiting monsoon to spread across India. But broadly, globally, food prices have been quite controlled. That also bodes well for India as well, because any supply shortfall can be offset through global food imports. If we look at US and Latin America, especially, those agri markets are doing quite well. So whether you look at corn, you look at coffee, you look at cocoa, you look at soybean, etc. Despite record buying by China, these food products are coming down. Sugar is coming down. So we do expect, inflation on the global side to remain quite well managed. So broadly, it's in a way reversal on the inflationary front as well. While the month of March to mid of June, the world was gearing up for a much higher inflation, and now with the opening up of Strait of Hormuz, now world is looking at disinflation. We also had the change of guard at the Federal Reserve. So Mr. Jerome Powell, who was the chairperson of FOMC, his term had expired, and Mr. Kevin Warsh was appointed as the chairperson for the Federal Reserve. and his first meeting was observed quite closely because, in a way, Mr. Powell went in a quite acrimonious way, where the U.S. president was quite certain that U.S. interest rates need to come down, they need to support growth, and that's why the U.S. president appointed Mr. Kevin Walsh as a Fed chair, because he believed that probably he can take a different view of the Federal Reserve, and that's why the market participants were very closely and keenly awaiting this June meeting, because they wanted to understand in which direction now the Federal Reserve would really go for. And if you look at his debut, he did not disappoint at all. He, in fact, re-established his hawkish credentials. So before joining the Federal Reserve, he had earlier served as one of the governors of the regional Fed. And at that point of time, he was quite critical of Fed balance sheet, of Fed providing easy liquidity in the market, as well as keeping interest rates low. So if you overall look at the first meeting, the policy statement was way shorter than the previous Fed chairs. So broadly, going back to the Greenspan era. So if you really look back how Fed has evolved in the last 20-25 years, till the time of Alan Greenspan, Fed communication used to be quite narrow. It used to be focused mostly, uh, you know, on implicit actions rather than explicit forward guidance. After, of course, the global financial crisis, uh, Dr. Ben Bernanke, who was the Fed chair at that point of time, started to focus a lot on forward guidance and on better communication, because at that point of time, interest rates were close to zero. So the Federal Reserve thought that since they cannot bring interest rates below zero, and they were anyways low, probably a better communication and better, stronger forward guidance will further help the financial markets. And of course, that messaging was carried across by Dr. Yellen, who was the Fed chairperson after Mr. Bernanke, and by Jerome Powell as well. So we are in a way going back towards Greenspan era, where there was not too much of a forward guidance. There was, like I said, very short policy statement or press release, and of course, the dot plots for 2026-27 rose by 40 to 50 basis points, which basically is back to the current Fed fund rate. So the market, or the Fed, collectively Fed governors, had given about a 50 basis rate cut expectations in next 2 years, and hence market were expecting a couple of rate cuts by the Fed. Broadly, they've gone back to 3.6%, which is close to where the Fed fund rates are today, and hence any rate cut expectations were pushed out. So apart from the policy, Mr. Kevin Walsh also formed 5 independent committees or task forces to review Fed inflation framework, whether the 2% inflation which Fed tracks right now is really logical, and to what extent that 2% level, or whatever level that committee decides, should be maintained, whether it should be maintained on a forward-looking basis or at an average level or at an absolute level at all points of time. So that's something which the Federal Reserve Committee, which Mr. Walsh has set out, will decide probably by December. So just to give an example, various central banks look at inflation target differently. So for example, when India looks at its 4% inflation target with a band of plus minus 2, they are broadly looking to achieve 4% inflation in the medium term. So their reaction function is not very dogmatic. It's not very symmetric. So they also look at growth. So in times of market shocks, like whether it was COVID, whether it was Russia-Ukraine war, or whether it's the Iran-US war, right now the RBI tends to ignore uh, temporary spikes in inflation, as long as they're aware that probably over a long period of time, inflation will move towards 4%. So there is no specific time frame that RBI tries to maintain 4%. For example, if you look at ECB is quite dogmatic and about its 2% inflation target. So when inflation is below 2%, they also try to infuse liquidity. They ensure interest rates are low enough so that inflation starts to move towards 2. Similarly, when it's above 2, they also try to bring measures irrespective of the growth sacrifice to ensure inflation goes around back to 2%. So far, the Federal Reserve was again looking at inflation more asymmetrically. So where when inflation used to go down below 2, they would not undertake too much of measures. But when it was going above 2% for a long period of time, Fed was expected to hike and to tighten policy rates to ensure that inflation goes close to 2. So basically, in a way, Fed would react more strongly when inflation would be above 2 rather than when inflation would be below 2, which is slightly in contrast to what the European Central Bank does. So basically, Mr. Walsh has kind of called for a whole review of the Fed inflation framework and to reassess whether, firstly, the 2% inflation target is desirable. Secondly, what time period probably it should be focused on. And thirdly, what should be the reaction function in case inflation is deviating from that particular inflation target. Similarly, like I said, historically, Mr. Walsh had been quite critical of Fed maintaining a large balance sheet. In his view, this kind of large liquidity infusion and balance sheet distorts financial markets, and hence he has asked for a review whether what is the right size of Fed balance sheet in the current size of the economy. The third is the communication strategy. Like I said, there was no forward guidance, by the Federal Reserve. Even the press release was quite short. So probably they want to, review it holistically. What kind of communication should really Fed go for? Like I said before, the global financial crisis, the Fed communication used to be quite obscure, and after the global financial crisis, it changed. So probably how they see that. In fact, even the chairperson of the committee has been formed. So Dr. Mervyn King, who was earlier the governor for Bank of England and later on the governor for Bank of Canada, he has been appointed as a committee chairperson for the communication strategy. He's also formed a committee on data sourcing, so the kind of data that Fed looks at, and also on productivity. So like we talked, AI, of course, the whole world is talking about AI. So what kind of job growth in the US is really compatible with the kind of AI adoption that we are seeing? So very, very interesting things. They have, in a way, they can influence global central banks quite meaningfully over the course of next 12 to 18 months, because whatever Fed does, of course, it has an effect on rest of the central banks and monetary policy as well. So we need to really see how these committees recommend and what recommendations are really adopted by the Federal Reserve. So while the market, like I said, took the signal as quite hawkish, the rate cut expectations were pushed out. At least we at UTI, we do not really see, Fed's reading as very, very hawkish. So right now, market is assuming the worst from the task force. Market assumes that everything the task force will recommend, will be quite hawkish and leaning on more on anti-inflation than on the growth side. We think the recommendations could be quite balanced, because there is also a view in US economic circles that probably because of heavy adoption of AI, we could see some job losses as well. And also, over a long period of time, as productivity improves because of AI adoption, that will be, from a long-term perspective, quite disinflationary. So overall, that's the view. Probably Fed actions may not be as hawkish as market fears. So we think we really have to watch out rather than take a preconceived notion that Fed will necessarily be hawkish. Of course, at this point of time, inflation is above the target. Inflation at the end of May was at 4% compared to the 2% goal. So of course, right now, inflation is not really favorable for bond investors. But we believe that as the base effects of the tariff issues play out, as the oil prices come down, probably we'll see some disinflation going ahead. So this was largely, this table represents the change in 10-year benchmark sovereign bond yields. So, like I said, just like in on the growth side, whether on the PMI, the behavior of bonds was also quite uneven. So, for example, if you look at whether it's Australia, whether you look at Mexico or India, we saw some rally. And if you look at, for example, Indonesia or US, etc., we saw some pickup in bond yields. Largely mid-month, like I said, as oil prices corrected, we saw inflation figures coming down, which led to a rally in several developed bond markets. As UK and Australia, if you can see, so already we had seen in, for example, in UK bond yields going from fourth quarter somewhere in February to 5% by April, and since then they have been coming down. And similarly, if you see, Mexico as well, they had also seen a sharp reversal in the bond yields from 866 in February to 940, and we saw some correction in bond yields from such high levels. But broadly, if you look at some of the other economies, for example, like Brazil, etc., where people are concerned about the fiscal impact of the US-Iran war, supply chain disruptions on the other economies, for example, like Indonesia as well, where people are concerned about, again, the inflationary impact of the supply disruption as well as the fiscal impact. We saw some pickup in bond yields. So again, an uneven global bond market where the local factors are also dominating as well as global structural factors. So we think probably this will continue to be the trend. So we can't. That's why I can't just take a one-sided view from the Federal Reserve or global monetary policy. We think local factors will continue to dominate the bond markets, where the local news on inflation or the local view on fiscal will also influence bond yields rather than just global bond yields. Thank you. So now coming to India. So, before we really start with how we are looking at the current, market opportunities, it's good to take a stock of where we were before the conflict, where we really went towards the conflict, and where we are right now broadly. So if you look at the pre-conflict, which was 27th of Feb, so basically the conflict started on 28th of Feb, where the US fired the first missile towards Iran. If you really look at the pre-conflict, oil was well controlled at 70. The US 10-year bond yield was at 395 because the market was anticipating that AI will lead to a lot of job disruptions. And probably at that point of time, there was peak concern about the removal of Jerome Powell towards a more friendly Fed chair. So people were expecting US rates to come down. If you look at USD INR rate, that was 91. Overall, bond yields for Indian, whether government bonds or corporate bonds, were quite well controlled. Of course, growth expectations were quite high. We were expecting growth around 7 to 7.5, inflation to be quite low. And hence, monetary policy, the expectation was that probably RBI will go for a long pause because inflation was well managed between 4 to 4.5. Last year, inflation was around 2%. So when you're coming on the back of a 2% inflation, even if the inflation is 4.5, there is a base effect, and probably that's why RBI may not hike rates, at least in this calendar year. Of course, during conflict, those assumptions got upended. So if you look at oil, it went all the way from 72 to 120 peak. If you look at the US 10-year, it went to 467. INR went almost to 97. And of course, there was a massive sell-off in bonds, whether you look at government bonds or corporate bonds. And rightly so, because there was a concern that probably India will face major fiscal issues as well, because we had to provide for lower oil prices at the local pumps. We had to provide for fertilizer subsidy, food subsidy, etc., etc. And of course, the current account deficit, like you can see in the table, was expected to move from 1.5% to 2.5% of GDP. The balance of payment was expected to swing on about 40 to 70 billion because of the continuous FPI outflows. And the view on currency was that probably currency would continue to depreciate. And it was expected that probably RBI may have to hike at least by 100 to between 150 basis points in a very short span of time. One, to manage inflation, and secondly, also to prevent any currency depreciation meaningfully. But what you see today is quite a different picture. Oil has come back to the pre-conflict level. So when the conflict was raging on at the peak between April and May, there was an expectation that even when the conflict ends, it will take some time for oil supply to resume, and probably oil supply, uh, and given the oil supply, oil will remain around 85 to 90. But given the, like I said in the beginning, given the huge gush of shipping and uh, lines which were really waiting for the Hormuz to open, we saw a very heavy supply of oil during that time. At the same time, China has not tried to replenish its strategic reserves. So just to recall, during the peak of conflict, which is between March and May, China had sharply reduced its oil purchases, and it was using its strategic reserves uh, to kind of meet its oil requirements. So it was expected also that once the conflict ends, oil prices go down back to $70 to $80. Probably China will try to refill its strategic reserve, which will also take oil back to 85, 90. But China so far has not tried to refill its strategic reserves as it tries to move its economy towards more of electrification, towards more of renewable energy, and hence we are really not seeing massive demand from China, and that's also helping oil prices stay low. Of course, we saw rally in the US 10-year, we saw rally in the Indian 10-year or the Indian bonds. Largely, of course, we saw more rally in Indian bonds compared to US. And one of the reasons, of course, like I said in the beginning, was removal of the withholding tax and capital gain tax from the for foreign investors into Indian bonds, which is expected to lead to probably Bloomberg index inclusion, and that led to a significant amount of rally in Indian bonds. At the same time, if you look at inflation expectation, which was expected to go around 5 to 5.5, that's also come to 4.5 to 5%. So on the inflation side also, things are much better. So what it really means for monetary policy. So if you look at the peak during the peak conflict, RBI was expected to hike by 100 to 150 basis points. Now with inflation probably expected to come down, rupee being much more stable, probably now the market is expecting 50 to 75 basis of rate hike during this monetary policy cycle. So basically from 100 to 150, the interest rate hike expectations have come down by 50%. And that's a benefit, whether we call it from currency as well as from lower commodity prices also. But is all well on inflation? That's something which we'll have to see. But before inflation, we also have to look at fiscal, the kind of fiscal deficit that India may be looking at this year. So if you look at the negative fiscal shock, of course, like we said in the beginning, the Hormuz closure not only affected oil prices, it also affected fertilizer prices. And since India is one of the biggest importers of urea, and India sells urea at a predetermined price, our urea subsidy, of course, increased. In the budget, we had provided for about 1.7 lakh crores. At the peak of conflict, the fertilizer ministry officials had said that probably the fertilizer subsidy will have to be doubled. So from 1.7 lakh crores, it will have to go towards 3.4 lakh crores. Of course, with now oil prices coming down, and let's say if we expect oil prices to remain about 85 to 90, we do expect the subsidy to come down, probably rather than hitting a 1.7 lakh crores to close to 1 lakh crores. Even on the excise duty, with oil prices now coming down, we expect excise duty to impact to be there about 85 to 90,000 crores. There is also a growth impact because earlier, like I said, India was expecting a 7 to 7.5% growth, which is now moving towards close to 6.5 to 6.7. So as growth comes down, as corporate margins shrink because of the first quarter that we saw higher oil prices and supply chain disruptions, whether you look at consumer staples, you look at pharma, you look at cement, etc., there will be a shrink of margins. So probably again there will be a shortfall in tax collections as well. So 50,000 crores shortfall in tax collection and about a 25,000 crore shortfall or spike in LPG subsidy. These are UTI research estimates. So we are expecting about total 2.6 trillion rupees negative fiscal shock. But of course, the whole shock will not be passed on on the exchequer. If you see what the government has also done, they have raised export duty on diesel and ATF, which is expected to get about 75,000 crores. The government of India also had some cash which was unutilized from last year, which was about 65,000 crores. So they have taken that cash and they've created an economic stabilization fund, which will offset some of the fiscal impact that we are talking about. They've also raised import duty on gold, which is expected to get them about 50,000 crores net. And if you also look at RBI dividend, this year they also got higher RBI dividend than budgeted, which is expected to get them about 1 point in a total 1.97 trillion. So broadly, the net negative fiscal impact is expected to be about 60,000 crores or about 0.16% of GDP. Mind you, this assumes oil at 85. If oil were to again spike above 100, then the fiscal maths again changes. We have to reassess how that will pan out. But as of now, we think 85 is a reasonable number to begin with. But more importantly, what we think is, despite a fiscal impact of 50 to 60,000 crores, we don't think it will result in any extra borrowing because government always has the option to cut some short-term spending. So we think there will be a mix of spending cuts on the revenue side, and there will also probably some increase either in small saving or TD. But we don't think there will be any increase in dated borrowing. Coming to inflation, like I said, while oil prices, are benefiting the inflation outlook, but if you look at the monsoon, that is meaningfully clouding the food inflation outlook, especially. So if you look at, the June inflation or the June rainfall so far, it has been the fifth weakest month of June in terms of monsoon since 1901. So in the last 125 years, it's one of the worst monsoon periods for June. Even if you look at the starting period, typically monsoon arrives in Kerala by 1st of June. This time monsoon arrived by 4th June. So overall, again, there was not only a deficit rainfall, there was a delay in the arrival of rainfall. And if you really look at the dispersion of monsoon, central India was the worst affected with some deficit rainfall about 60% during the month of June. If you look at southern part of India, that was also quite adversely affected, getting about 38% lower rainfall than long period average during the month of June. So we really need to see, of course, July has started well. We are seeing excess rainfall in many areas, including the Western India. So probably we'll see some of the deficit being kind of plugged. But so far, if you look at the June rainfall, the IMD had forecasted that rainfall will be 8% below normal. The actual rainfall was 40%. So that's the kind of gap that the monsoon has to probably fill in the month of July. And July is the best course for any gap in monsoon to be filled because from August, September onwards, as per various weather forecasts, the El Nino effect is supposed to intensify. So probably we'll get slightly adverse rainfall in the months of August and September. So July is probably our best course of action to plug that gap and to fill that reservoir capacity, which will help us both in Kharif and Rabi crops. Because if you look at the Kharif sowing or the summer sowing so far, if you especially look at whether pulses, oil seeds, or cotton, they're all well below the typical pattern which we see during this month. For example, if you look at pulses, 30% sowing has been down compared to last year, or if you look at oil seeds, 53%. So of course, the government of India is working with the farmers. It is encouraging farmers to switch to more or less water-intensive crops. So probably, and that is typically your oil seeds and your pulses. So probably, as the monsoon picks up in the month of July, we'll see some pickup in sowing for these food crops. But more importantly, we may see some seasonal spike in inflation for the next 3 to 4 months before the winter season starts to come in and we see arrivals. RBI has projected a Q2 inflation of 5.1%. So probably actual inflation may be higher than what RBI has estimated. But more importantly, RBI has clarified repeatedly that they are looking at this inflation as supply side shock, which is one time, and they will ignore it unless and until it feeds into long term inflation or core inflation. RBI is probably and most likely to ignore at least a couple of prints. So, hence, we are not really looking at any rate action in the August policy. If you look at the trade deficit as well, the trade deficit continued to remain elevated. Just to give a perspective, in March it was 20 billion, it ballooned to 28 billion, and it stayed that way. And this is despite pickup in non-oil exports. So if you look at the non-oil exports, we saw a sharp jump. So despite so in April also non-oil exports grew by 9%, and on top of that they grew by 12% in the month of May. So overall, non-oil exports are doing well, especially if you look at our exports to Asian economies, while the US-bound exports continue to remain quite stagnant. But if you look at where the trade deficit really ballooned, if you look at the oil imports, so oil imports in the month of March was just about 12.2 billion. It doesn't mean that oil usage has gone up. What really happened in the month of March, because it was just at the end of February when the Iran conflict started, there was a major supply challenge in the month of March, and hence India could not import the desired quantity of oil in the month of March. And that's why we are seeing a sharp fall in oil imports. But as India was able to diversify its oil supply chain, so whether you look at oil supplying from Russia or whether you look at even from Venezuela, India was able to ramp up its supply chain, and hence we are seeing pickup in oil imports. We do expect that both with Hormuz being open, supply chain should normalize, and a lot of that oil price also being down, probably oil imports should come down. So we do expect this trade deficit to stabilize in coming months. Also, more importantly, the upcoming INR outlook should be quite beneficial from the lower crude prices or from the FCNR ACP related outflows. But the sustainability of INR or the appreciation of INR will be more important on when the FCNR window ends, because RBI also has a large net short position of about 107 billion, out of which 56 billion is more than 1 year. So how RBI manages that short position when more FCNR flows come in, and how it manages its forward book, we'll also need to see post September. We'll also need to see what are the growth outlook from India, because that will also determine FPI flows into India, especially on the equity side, which will also kind of influence INR trajectory. We talked about FCNR, and there are all sorts of media reports that there could be significant flows in FCNR of 50 to 80 billion, or some estimates even say 100 billion. So we thought it would be useful to really see why market participants are talking about these kind of flows, especially when US interest rates, like we saw during one of the previous slide at 4.5. Why will somebody invest in India at a 6% or a 7% interest rate? So the real catch in FCNR is not really the interest rate, which is a 6 or 7, but because RBI is bearing the full cost of the swap for the period of 3 and 5 years, a bank can offer a leveraged deposit to a non-resident Indian, where a non-resident Indian, for example, invests $100,000, they get a 10x or a 15x leverage, which on top of that deposit, which is let's say 1 million or a 1.5 million. So the total pool of investment for that non-resident Indian is not 100,000, but it's actually 1.1 million or 1.6 million in this case. And the typical cost of borrowing for that, because it's loan against deposit, and there's a RBI risk involved, so the risk is quite low. The borrowing cost becomes very nominal, which is 5%. But if you look at, you're getting a 1% differential. So basically 1% differential at a 10x leverage, straight away, you are able to make a IRR of 16%. If you take a leverage to 15x, you can make a IRR of 20%. And that's in dollar terms. So a 3 to 5 year IRR of 15 to 20% is quite attractive for investors. Of course, for non-resident Indians, there is a certain home bias as well. We every year we see remittances of more than $100 billion from non-resident Indians. So we do expect that this scheme will be taken up quite well by non-resident Indians, and we do expect flows about 40 to 50 billion dollars from non-residents. The second scheme, which is also expected to get about 10 to 15 billion dollars, is the RBI ECB scheme, where RBI will bear half of the cost of the 3-year forward by state-owned entities. So it's only open to state-owned entities. It's not open to the private sector. So typically, if you look at the current forward rates, the withholding tax, etc., typically the all-in cost on a fully hedged basis for a state-owned entity, which is a AAA, is about 8.5%. And the 3-year bond yields are close to 7.25, 7.30. So of course, it makes sense for those state-owned entities to borrow from domestic market rather than go towards the offshore market. But with the swap being in place, so if you look at this, the second line in my right-hand side table, so instead of 3%, the state-owned entity only has to pay 1.5%, because the 1.5% will be borne by RBI. So straight away, that cost, which was 8.5%, moves to 7%. And now it becomes cheaper for the state-owned entity to borrow from offshore rather than onshore. And hence we expect 10 to 15 billion dollars to come from that window as well. Why not more? Because of course the capital towards Indian credit is limited, the risk appetite is limited. Investors who look at India look at sovereign Indian risk as well, corporate India risk as well. But typically it's largely EM focused investors. There is only a limited pool of capital which is available towards India-focused corporate bonds. So we do expect beyond, it will be difficult to get more than 10, 15 billion dollars in this window. But even if we get, that will be quite welcome again for the domestic bond market as well, because this has an implication on all our portfolios. Because as these entities will go and borrow from abroad, they will borrow less from domestic market. So as the supply of corporate bond comes down in the domestic market, that is quite good for corporate bonds up to 3-5 years. Because when these entities go and borrow this 3 to 5 year segment abroad, basically they will be supplying less bonds to the domestic market. And that can lead to some spread compression and some rally in the corporate bond in India. Moving on to the next slide. So apart from improving corporate bond yields, this measure is also expected to boost liquidity. So one, these measures will help diversify corporate bond supply from onshore to offshore, because all this money will flow into India, which could be 50 to 60 billion dollars. In simple terms, taking a 95 USD INR rate, you are looking at about 5 lakh crores of liquidity straight away coming into India. So your system liquidity, which is close to about 3 lakh crores right now, can move towards 8.5 lakh crores. And of course, as the government spending happens, currency leakage happens, that liquidity will go down. But this 5 lakh crores of liquidity, which can come in the next 3 months, was not anticipated in the beginning of the year. So as that liquidity comes in, you will also see, and all this liquidity will come into the banking system. So basically, banks will have less incentive to issue high rate CDs as well. So if you look at the money market curve as well, so I talked about the corporate bond curve in the previous slide. If you look at the money market curve as well, that will also see tremendous improvement once these flows start to trickle. So you will see the benefit across from 1 year part of the curve to all the way to 5 year part of the curve, because of heavy liquidity from FCNR, as well as the state-owned entities doing offshore bond. Does it work? This is a 2013 example. We saw, and so we saw similar move in September 13 when RBI announced these measures in the FCNR deposits. And look at the liquidity growth post September 13. It was growing between 6 to 8%, and it went straight away from 8% to 14%. Again, it started to come down after June as the effect of liquidity went out. But for the next 4 or 5 months, liquidity really picked up. look at the deposit growth. Because all those deposits came into the banking system, we moved from an 11% growth rate all the way to 17%. And that has an implication for the CD issuance as well, because as banks get those deposits, which are sticky 3 and 5 years, they don't need to issue a very high cost CD market or high cost CD in the local markets. That's something which will benefit the money market funds, the ultra short term funds, or the low duration funds category as well. Broadly, credit momentum remains quite strong related to deposits. If you look at the headline food credit, it's growing at 17.5 as of 15th of June compared to 15.6. If you look at the industry growth, again quite remarkable at 17.5 compared to 15.1 in April 26. Mind you, the sectoral deployment comes 1 month uh, with a 1 month lag compared to the deposit and credit. So you may see it surprising that we are discussing the credit and deposit growth of June, but we are discussing the sectoral deployment of April and May. It's because of 1 month lag that you have to we have to analyze this slightly before. But broadly, if you look at the overall trends, they continue to show strong growth across sectors. So when you look at infrastructure, look at services, we are seeing strong growth. This is quite good from a growth perspective, because what FPI and equities are looking at is, when can India bounce back to its historical growth rate? So if India can demonstrate a growth close to 7% in this financial year, that could lead to a surprise on the macro side and surprise on the FPI side as well, and can probably help further in INR stability. Broadly, the SDL calendar was also released. No major surprises there. As we can see, on the gross borrowing, it was pegged at about 6.6% higher. If you look at net borrowing broadly at the similar level last year, interestingly, what the RBI has done since the beginning of this year is they have come up with a benchmark issuance strategy where states kind of define the tenors in which they will be issuing the bonds. So the market knows beforehand that what kind of tenors will be coming in. So it's not just the amount, but it's also the maturity so the market can plan for and can bid accordingly. And it also gives certain predictability to SDL issuance. So probably as these bonds become more frequent, as you have benchmarks, not only in GSEC, but also in SDL, from a long-term perspective, it's a good tool. Of course, it just started this quarter, so probably will take 4 to 6 quarters for those benchmarks to become more mainstream, to have a certain size and to trade more actively, but it's a step in right direction. So earlier in the Q1, we had about 9 states which had adopted BIS or the benchmark issuance strategy. For Q2, 10 additional states have also adopted BIS. So that bodes well for the SDL market liquidity in the long term. Moving on to the T-bill borrowing calendar. So broadly compared to last year, if you look at the net T-bill supply, largely what we saw during last year was that government borrowed less from the T-bill. So they actually borrowed on a net basis minus 35,000 crores. This year T-bill distribution is much more balanced. So far they have borrowed negative minus 13,000 crores as per the calendar. So like I said in the beginning, even if there's some fiscal impact, we see probably government borrowing more on the T-bill side rather than on dated borrowing, because you have easy liquidity and it's a temporary fiscal mismatch. And interestingly, government is also trying to elongate its T-bill borrowing. So if you look at the mix of T-bill, which is typically 91, 182 day and 364 day, the mix of 91 day has seen a significant decline from 47% to 37.5. And if you look at the split where it's really gone, it's almost split evenly between 182 day and 364 day, where their proportion has increased. So government is borrowing longer on the T-bill side. They're not trying to do just cash management, although they're sitting on huge cash balance, but they're trying to keep the T-bill calendar predictable by borrowing regularly, so that to ensure that they have enough space at the end of the year as well. So broadly on the sovereign curve, it continues to remain quite steep, where you are seeing front end quite at the lower levels. We do expect steepness to continue, at least for the next 3 to 6 months, because you will have a huge gush of liquidity coming over, and those banks will also invest in the 3 to 5 year segments because their deposits are also 3 to 5 year. So probably curve will remain steep for a while. And of course, when you get close to a rate hike cycle, that is when you may see some flattening of the yield curve. Broadly looking at the trends, like we saw in the month of May, yields had spiked up. 1 year levels had gone to 788. Now they've gone back to 713. If you look at 3 year as well, they've gone from 778 to 7.18. So we saw a rally across. Look at 10 year as well, again from 780 up to 736. So good rally seeing all across the credit curve, whether incumbent bond, AA, etc. Given the benefit that we are expected to see further from FCNR as well as from lower oil prices. So broadly on the outlook, like I said, our macro outlook was quite sanguine till February. Of course, after the war, it turned quite adverse. But today, if you look at the macro mix, apart from the El Nino concern, which we talked about on the weaker monsoon, apart from that, whether we look at on the currency, on the inflation side, on the fiscal, or on current account, everything is pointing towards a favorable macro outlook. So we think earlier the expectation was that probably RBI will hike by 100 to 150 basis points. Now the expectation is 50 to 75. So probably that should keep the front end quite anchored. Secondly, like I said, because of the huge liquidity that we expect to get from the FCNR as well as from the ECB borrowing that state-owned entities are expected to go for, the front end or the moderate duration, which we have been talking about since the last 6 months, should really benefit from this. So with that remains the preferred segment. So investors who are looking at 3 to 12 months investment horizon can benefit from money market or low duration strategies as CD issuance comes down due to liquidity. Of course, investors who have more than 12 months horizon can look at short-term or corporate bond fund to benefit from reasonable accrual as well as some roll down opportunities as we see high FCR investments. And of course, investors who have investment horizon of more than 2 years can consider income plus arbitrage as you can get a favorable tax treatment there. So broadly, this is where I would stop, and happy to take any question. Thanks a lot for listening in. Thank you.
Thank you, Anurag, for sharing your perspective. That was an insightful discussion covering everything from evolving global macro environment to domestic outlook and its implication for fixed income markets. We have received some interesting questions from our participants. So let's now move on to it. So the first question is, global bond index inclusion has already begun changing the ownership profile of Indian government securities. With further index inclusion under consideration, beyond the initial flows, how do you see this reshaping the Indian bond market over the next 3 to 5 years?
Right, that's a very interesting question because, yes, while we have been included in various global bond indices, all the bond indices where we have been included so far are EM bond indices. So the investors that we have are all EM focused bond investors, and typically they tend to follow a cycle. So whenever there is an easy liquidity cycle globally or an easy monetary policy cycle globally, especially in the US, flows tend to come towards the EM, and the US interest rates start to harden, the funds tend to experience outflow from EM. And hence those flows are cyclical. If India does get managed to include in the Bloomberg Global Aggregate Index, those investors are all weather. And those investors tend to invest across interest rate cycles. If you look at the size also of the Bloomberg index, that's about the funds which are tracking Bloomberg index, that's about 2 trillion. So one, the size is much bigger. Secondly, the investment horizon is all weather. So probably that if we get included, that money will be much more sticky rather than cyclical. That money will be much more structural. And that, in fact, will encourage other investors as well, because that flows will also reduce volatility for Indian bonds. Although they are volatile, I would say much lower compared to other EMs as well. but those investments will further reduce volatility in Indian bonds.
Thank you. Uh, the next question is, with AI investments driving capex globally and government continuing to invest in infrastructure, do you think the world is entering a structurally higher interest rate regime than what investors became accustomed to over last decade?
See, structurally, I don't know, because, like I said in the one of my comments on the when talking about AI, that over a long period of time, probably AI can be disinflationary because it will lead to huge productivity unlocking. So structurally, I don't know, but cyclically, yes, because of all the investments that are right now being done, whether it's in data centers, whether it's in transmission line, whether it's in power consumption, or building, towards more sophisticated language learning models. It A lot of that is coming from the private sector globally. So largely, it's the private sector which is driving this capex, and a lot of that investment is coming from debt rather than equity. So of course that means more bond supply. For the market, that means also probably some credit accidents because firms which are not able to survive during this whole AI disruption probably will also see a spate of defaults as well. So probably I would say in the next 2 3 years we may see bond yields on the corporate side remaining high, but whether we can say it structurally that that's still I think a jury's out there because I think overall the long term this should be similar to internet or e-commerce that overall we should see lower prices on a steady state basis. So probably structurally it's not really inflationary, but that's my view. We'll see how really it pans out over a period of time.
One of the biggest debates in global fixed income markets today is whether rising bond yields are primarily reflecting inflation concern or a structural increase in the fiscal borrowing and term premium. How do you see this evolving and what could it mean for Indian bond markets?
So globally, I think bond yields are reflecting both because if you look at inflation, especially after COVID normalization post 2021, inflation typically used to be 1.5% on the in the advanced economies. Initially, it was termed as COVID side disruption, but that apart from the COVID normalization as well, if you look at global economies, inflation has been high. It's close to 2.5 to 3% rather than 1.5%. So there is a consistent shift in supply chain and on the inflationary pressure. So it will be wrong to say that it's just on the fiscal side, it's on the inflation as well. And they are self-reinforcing because as you spend more, as you grow more, because the fiscal is high, of course, the economies are experiencing higher growth than they would if those fiscal deficits were not high. And as those fiscal deficits become high, they lead to higher growth, and that leads to higher inflation. So it's self-reinforcing. And as you get higher inflation, there is a tendency to keep on pumping more money to ensure that citizens are well covered during periods of high inflation. So what we have seen historically, and that's historical, whether you go back 100 years or 200 years, typically as long as fiscal expansion is put into productive capacity, into capacity building, infrastructure creation, any higher fiscal leads to higher inflation, which in turn leads to higher bond yields. So for now, it's a mix of both, uh, and probably I think the inflation part will come down first before the fiscal part comes down. You are on mute, Sandeep.
Sorry. Over the last year, some of the most meaningful moves in the bond markets have followed changes in the liquidity conditions, foreign exchange measures, and regulatory initiatives rather than policy rate actions. Now, has market started placing greater emphasis on the financial conditions than on policy rates? What's your view on that?
I think markets, I don't know about that, but I think largely markets tend to look at policy rates and inflation. I mean, as far as the bond markets are concerned, while in the very near term they may get influenced by liquidity actions, but overall, bond yields tend to follow a simple model of inflation versus growth, and where the policy rates are likely to be. So, for example, if you look at the UK, that's one example that people can look at, and that's where if you are seeing there's a very high cocktail of inflation as well as high fiscal deficit, and there is no room to bring that down. So no matter how much liquidity you pump in, which is there globally, bond yields in the UK are going up because of that. So it's always about, I think, fundamentals over a period. So while you can influence bond yields or market probably for a period of 15, 20 days or a month, but over a long period of time, what really moves the market is the expectations on fiscal, inflation, currency. These are the most dominant drivers. So if you take the example of QE by Federal Reserve as well, between 2008 till 2020, when US Federal Reserve was printing and expanding its balance sheet, uh, that did not bring the bond yields down. What brought the bond yields down is not only that liquidity, but also that US inflation was below 2%. And hence, there was no expectation of Federal Reserve rate hikes. Despite Federal Reserve balance sheet being high, the same interest rates are much higher right now because inflation expectations in the US have gone up. So it's always about, I think, the fundamentals rather than liquidity or any short-term announcements.
Thank you. There's this question. What's one widely held market consensus on a fixed income markets today that you disagree with?
I think one consensus where we have stayed away, and that's also reflected in our portfolio views, so that when oil prices fell and bond yields fell from 705, 710, the 10-year bond yield to 675, we have not added meaningful duration to our gilt or dynamic bond funds, because our assessment was the short end will benefit more than the long end. And ultimately, we have to see how long oil prices remain at 70. And that's why we were underweight compared to our respective categories. So that's something where we were out of consensus. Of course, now we are seeing oil prices going from 70 to 78 in the last 3-4 days. So again, we would say probably the market will continue to be volatile, because in geopolitics, whenever there's a tension, I mean, Russia-Ukraine is still going on after 4 years. So you have a noisy period. So probably it makes sense to take a large call after you have sufficient clarity or conviction. So that's something where we have been out of consensus.
Sure. Thank you. I'll take one last question. This is from Mr. Deepak. He's saying that he has invested in the Guild Fund and the Constant Maturity Fund, which is maturing in December 2023. Now, he doesn't need these funds for next 10 years. So should he liquidate and invest in the short-term MF now or remain invested? So the larger question is that when should he enter the Guild Fund and exit to benefit out of the duration game, as he is not so comfortable with the interest rate volatility?
Right. I'm not sure whether, just to be clear, on the constant tenure, as the name suggests, the fund will maintain a constant maturity of 10 years. So the fund does not mature in December 26. I mean, I'm not sure what, probably I think he invested in December 23. His 3 years may get completed by December 26. Anyways, the indexation is really out today, not available to investors right now. As far as I think the expectations of any fixed income investors from a fixed income product is that they want stability, they want predictability, they want liquidity. Right? So I would say, rather than chase short-term momentum, if an investor has a 10-year horizon on you, that's a very good clarity to have, because most of the investors don't have that clarity. So really kudos to Mr. Deepak to have that clarity. And if you or any investor who has a clarity that they want to invest in a fixed income product in a pure asset allocation for a longer period of time, I would say, especially for a retail investor, income plus arbitrage is a very, very appropriate category because you are at a, you don't have to be subject to tax at your marginal rate. You only have to be taxed at 12.5%. And a large part of the debt, if you look at in the income plus arbitrage, 65% is oriented towards short-term or a corporate bond fund, and the rest 35% is arbitrage, which are fully hedged position. So the 35% arbitrage is quite stable, fully hedged position, and the 65% gives you a short-term fund experience. See, typically interest rate cycles in India are shadow. So a typical interest rate cycle will be 2 to 3. We are not looking at any interest rate super cycle of 10, 15 years. So given that we have an interest rate cycle of 2 to 3 years, if an investor has to benefit, probably where probably a product maturity is towards, I would say 2 to 4 years is something where an investor can benefit over a long period of time and also get the benefit of stability and predictability. So, these are largely cyclical funds where probably you will get some benefit in the near term, but these have to be seen from one has to really respect the volatility and withstand the volatility. So if you are uncomfortable with the volatility in a gilt fund, probably a income plus arbitrage category is a better product for you. Of course, gilt funds are, can deliver meaningful value because they can play across the curve. And since you have a long-term investment horizon, it works. It can work over a long period investment horizon. But of course, because they tend to have higher duration band, they tend to be slightly more volatile than let's say a short-term or a corporate bond. So that's the trade-off that one has to do. If you're comfortable with volatility but over a period of time, you can consider gilt fund. But if you want more stability, more predictability, then probably a corporate bond fund or an income plus arbitrage is a better product.
Thank you. Thank you, Anurag, for answering all the questions and helping us connect the dots across global and domestic macro environment and what it means for fixed income investors. And thank you to all our participants for joining us and sending your thoughtful questions. We hope today's discussion has provided the useful insights into the evolving macro environment and the outlook for fixed income markets. We look forward to welcoming you again in the next edition of UTI Market Insight Fixed Income in the next month. Thank you and have a great day ahead.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.